work on fixed assets, and we're going to learn how assets are acquired in a business and how businesses recognize expense related to the assets over the life of the asset. So everything we do in this chapter is going to deal with long-term assets and acquisition. Anything we buy short-term, let's say a calculator or a pen, even though you're going to be using for longer time, because of the materiality of the asset and cost of the purchase, you most likely expense it in the year that you bought it, and it would not make it to the asset section of your balance sheet. Without further ado, there's a lot to discuss in this chapter, and we're gonna go step by step and cover different things. So as we're learning this material, we're gonna be actually kind of looking at an asset and everything that can happen to it. We're gonna go from everything acquiring the asset, depreciating asset depreciation under different methods, and actually disposing the asset. We can have a change and estimate how much asset might be depreciated if the circumstances have changed. We also might be have unusual disposal based on asset no longer be useful to us. We're also going to be dealing with different type of assets in this chapter. So hold on, get your pen and pencil, take your notes, and let's get learning. I'm going to share my screen with you and going to guide you through it with PowerPoint being my guide and some examples. But first of all, we don't do just fixed assets. We can have tangible and intangible assets as well. Usually, what we deal with and have dealt with so far, probably in accounting, is tangible assets. It's something you can physically touch, right, and see. What we call intangible assets, and we'll be talking about this in this chapter, things that you cannot see but also hold value, patents, copyrights, and so on. So tangible in nature, actively used in operations, is helping us to generate revenue, and we expect future benefit, which means we can keep using it in order to grow our business. So all of that is going to be in a property, plant, and equipment section of our balance sheet under asset. So there's different stages to us acquiring an asset. So initially, when we acquire an asset, we're going to compute the cost, and we're going to talk about what included in the cost of the asset. Then throughout the life of the asset, we're going to allocate the cost, and we're going to talk about it, how we're going to allocate the cost. It's not always going to be straight line. It depends on the company and how they're going to use it, and the asset, and the disposal of the asset as well. So what is included in acquisition cost? Before you start using the asset, everything that needs to be done to the asset for you to use it on that first day would be included in the cost of the asset. So taxes, somebody tuning your product. One of the examples I like to use, in Wisconsin, we had a plant. Well, Wisconsin is known for printing industry, and one of the printing presses were delivered, and it was not going to be put in through the normal door. So the company had to actually remove the roof, put down the machine, put the roof back on. They had, but the machine came from Germany. They had to have like 6 or 7 people come in and actually assemble the machine and train the staff on it. So in this case, everything, including cost of the roof, because roof was nothing wrong with the roof only was taken out and put back in for the purpose of putting this machine on, bringing 7 people from outside of the country for purpose of assembly and training people. All of the costs associated, not just the physical machine, obviously tariffs, transportation, and everything else, would be included in the cost of the asset, whatever it takes us to get this asset going. So acquisition cost includes all normal and reasonable, obviously, to require to start using it. You wouldn't be able to use a machine if nobody could assemble it or train you how to use that. So taxes, transportation, insurance while it's in transit, testing it, and so on. Now, when we're dealing with building, we have quite a few things, maybe more legal things involved. So any brokerage fee, cost of purchase or construction. We're gonna have some examples and a homework. If you buy um, if you buy a building with a purpose of actually living it, just tearing it down and using it as a land, that building is a cost of the land, really. Um, because you're actually buying it for the purpose of building a new building. So all of those things would be a part of allocation, and we'll talk more about that. But if you sometimes you buy something and it's turned down, and so you're buying it really for purpose of the land, um, or you can allocate that cost to the new building, if you can split the cost among the land and the building itself. So we'll be talking about that as well. So sometimes it's not very clear which cost is what because you're buying everything together, but there's a mechanism of doing that. Any land improvements we keep separately. The reason being because life of land improvements are different than the life of the building. And land is not depreciatable, so we keep the cost of the land separate as well. And land would require title insurance, purchase price, real estate commission. Sometimes you might buy a land with some problems that might have um, environmental issues, and cleaning that land also might be included in the cost of the land. So once you buy something and immediately you have to do some things to it, might be rolled into capital cost of the land. And the difference is one thing you're doing something initially in order to bring it to useful point for your organization to use, is another one you're doing something years down the road that becomes an expense. So there's a big difference if it's initial purchase or if it's something done later on to fix a problem. All right, let's talk about lump sum purchase. Sometimes you buy something altogether, and it happens a lot. If you buy a personal property, a house, you really buy the land and the house, unless if there's some kind of stipulation to it. So let's take a look at example. And I think examples, if you guys can slow down, maybe stop the video. If you need to make sure you can rewrite or redo this without looking at the answer after I go through it. This way you can apply this later on when you do some of the homework problems. So we have CarMax paid $90,000 cash to acquire a group of items consisting of land, and this is appraisal cost. $30,000 land, improvements is $10,000, and building appraised at $60,000. So if you take 30 plus 10 plus 60, it's $100,000. We bought it for 90. We got a deal. However, in accounting, we book things at the price we purchased at, right? So we purchased it at 90, we did not purchase at 100,000. So you're going to book it at 90. You're going to actually credit $90,000 cash. So you cannot put 100,000. So how would you be allocating this? So if you look at my cursor right here, we have to put 90 cash. We cannot put 100,000. So what we're going to do, we're going to look at 100,000 as 100%, and we're going to extrapolate that, right? And we're going to actually split that cost, right, among other items. So in this case, let's see, consider land appraised at 30, land improvement appraised at 10. So in this example, they put everything at 40. I would actually make it 3 category, but for the sake of this example, we're going to keep it together. I would actually have land improvement separate. So land we're going to say is 40, building is 60. We cannot book all 100. However, it represents 100%. I take 40,000 divided by 100, it's 40%. 60 divided by 100, it's 60%, right? This is your calculation. So now this is a percentages of the whole. Your whole pie that you paid is 90,000. So now you're going to take 60% times 90, 54,000 going to be allocated to building. And remember, building would be depreciated and land would be not depreciated. We have to book them separately. So land would be 36,000. So this is my journal entry for lump sum. Again, you could have a third category here for land improvements. I would actually kind of recommend it. But for sake of this example, we just have 2 you take appraised value. Appraised value not always going to be higher. It could have been lower. Appraised value could have been 80,000. You would still follow the same steps. You would use total appraised value divided by each individual items. You get your percentages and you apply it to appropriate costs that you paid. So this is your lump sum purchase and this is your final entry. All right. We're going to move to computing recording depreciation using straight line, units of production, and double declining method. That's something we have not done before. We did see straight line depreciation in the past, but not the other methods. So this is very important and some vocabulary would be new to us. So couple things. Once we book an asset we purchased, we always book it at a cost we bought. So acquisition cost, then we look at how long we're going to use the asset. So let's say it's 5 years. So now the cost we bought, we have to spread it over the use of a time. In my household, we have a couple computers, and I have to tell you, the newer computer getting used the most. That's the computer everybody wants to grab and use. So a lot of times the assets that are newer get used faster. So there's different methods, and double declining is one of them. Say, hey, if it's a brand new asset, we might want to decline that one faster. So with a straight line, we're going evenly across the board. With the double declining method, we're going to go faster. So we're going to do cost allocation. So it's sitting on the balance sheet, the cost itself. And then as time goes on, we slowly, as we're using it, we're moving it to income statement and expensing it. So if I open a barber shop tomorrow, I'm not going to go in one day expense $30,000 remodeling costs, and that year looks like I didn't make any money. I'm going to take that $30,000, let's say, allocate over 7 years that I have my lease, for example, on that building. If I don't own it, to match the timing, I'll be using this remodeling cost of 5 years or 10 years, depends the situation I'm in. Usually you want to do the least of your lease or time you're going to be using the remodeling cost. Okay, so we need a couple things to do this. We're going to need initial cost. It's important, not appraised value in the market, actual what you paid. Salvage value, what it's worth at the end of the life. So do you think you can get something for that computer at the end of the life? Do you think somebody will pay you some money for that car at the end of its life? So that cost doesn't need to be depreciated. And we're going to be looking at a useful life. Will I be using this computer for 5 years? Would I be using this car for 10 years? And again, it's an estimate. It's like a crystal ball we're holding in our hand. What are we thinking we're going to use that time for? So we're going to look at this example and kind of use it for a couple methods. So we're going to keep going back to the same information. We're going to look at an asset we think we bought at cost of $10,000. The salvage value, I think I can dispose the asset at $1,000 at the end of its life. Therefore, my depreciable cost is $9,000. So I need to get rid of $9,000 cost over my useful life of 5 years. I also think with this particular, it's an estimate, machine, I can create or inspect 36,000 shoes. So I don't need all of this data for all the methods, but that's what's given to me to get all my 3 methods across. So we're going to go through one by one. I have this one example, and then on homework, you get to practice this again. We're going to start with one we're more familiar with. It's your formula for straight line depreciation. We take a cost minus salvage value divided by useful life in number of periods we're going to use it. So $9,000, 10 minus 1, we want to depreciate over 5 years. Therefore, we're going to depreciate $1,800 every year for next 5 years. So if I'm going to own the asset for next 5 years, every year, little by little, I can spread the cost of me actually matching using the asset over that period of time. Now, you can see it's an even killed how we're depreciating it. Now, if you look at your book value, and this is very important definition, book value is your original cost minus your accumulative depreciation. So machinery cost me $10,000, right? and this is 2 years down the road, so 3,600. So my book value at the end of year 2 is 6,400. So right here, this is my year 2 after I own it. So I own it 2018. I started with 10,000, brand new shiny machine. Year 2 minus 1,800, my book value of the asset 8,200. That's a very, very important term because we're going to be using this when we're disposing the asset. Year 2, I have 6,400 book value because I now decreased by another 1,800, and so on, so on. So as the asset life goes on, the book value declines as well. Now, my straight line depreciation also could be put in a chart, and if we put this in the chart, my depreciable cost is 9,000. Depreciation rate, this is going to become very important in double declining method. It's 100% divided by 5. So 100 divided by 5 equals 20%. So really, if you take 9,000 times 0.2, it's 1,800. So it's the same thing we did before, but now we're doing it a percentage. Accumulative depreciation, 1,800. Book value, remember book value is what you bought it at, less any depreciation you have taken prior to that day. And we always stop right at our book value of the assets. So at year 5, if you're still using it and you still think you're going to sell it for $1,000, it will be sitting on your books at 1,000. Let's go to our second method. It's units of production method. So the interdependent, you're not going to do all of them. You're going to do one or another. And company usually make a call which method they're going to use in the beginning of a year, and they'll stick to that method. So we're going to say, as the same concept, we take a cost minus salvage value and say, we need to take that $9,000 in this case, and we're going to need to spread per number of units we're producing. So we take depreciable value divided by total units production. And every year now as we're producing it, so if you use it a lot, you're going to depreciate a lot. If you don't use it much, you're not going to use it as much. Let's say you bought a snowblower and it didn't snow much this year. Well, your machine probably not as used. It probably has more value in it. They have not run as many, I don't think it's miles, maybe hours on your machine. So less you use it, less you depreciate it. More you use it, more you depreciate it. Second step, you take to calculate depreciation expense, you take depreciation per unit, which you calculated in step 1, times number of units produced in the period. All right, so we're going to go back to our example, and we're going to assume this is additional information, that we have 7,000 units were inspected during the first year. Depreciation would be calculated as follows. So we have the same information, 9,000 depreciable cost divided by 36,000 units. Therefore, each time we produce a unit, we're going to have 25 cents per unit, 25 cents per unit. So if I produce 4 units, 4 times 0.25, it's $1 I will depreciate. In this case, a depreciable rate is 25 cents, and I have produced 7,000 units is given to me in a problem. Therefore, my depreciation for that year, 1,750. So again, you need to have that information. How many units have you inspected in this year? Of course, if you go above 36,000, you'll just stop because now you're above what you estimated. So in this example, and again, this is given to you, this is something you would not know unless it's given to you. We're assuming we produce 7,000 units or inspected 8,000 in 2020, 21, 9,000, 7,000, 5,000. So every year you do this, you're going to take it times 0.25, and you have your depreciation expense for those years. And it's unequal based on a production level. So this is how we do units of production. Now we're going to most favorite method, and I think students telling me a somewhat more difficult one. It's a double declining method, and it has 3 steps, and we actually starting out with a straight line depreciation concept and moving to double declining. And it goes back to my computer story. Brand new computer, brand new car gets to be used much more in my house than the old one. So again, we're starting out with the same cost. We have the same information of 5 years. We no longer care about units of production and units of inspection in this case. We just care about this data right here. So the first step, we calculate straight line rate. we take 100% divided by useful life. So we do need to do percentages for this one. There's no way around it. So 100 divided by 5 is 20%. That's your straight line depreciation. So for double declining, it's double the straight line. So it's exactly what we're going to do. We're going to take 2 times our straight line. It's 40%. So now we're going to double decline 40% from book value. Remember the term book value? Cost minus accumulative depreciation. That's the rate that we'll be using. So the very first year, and we're not going to start with 9,000. This is another mistake I see students make sometimes. We will stop at 1,000. However, we always start with a cost of 10,000 or whatever the cost is. So we start on a high end. So we're going to start with 10,000 times 40%. So first year depreciation is $4,000. Okay. So I'm actually going to jump into Excel here. I prepared this little sheet for us, and we're going to continue with that. So my first year, whatever that year was, 2019, we have 40% rate. We already determined that. So I'm going to say 0.4. So second, third, fourth, fifth. And this is my percentages. That does not change. And this is my cost. So maybe I'll start with that. Or book value. Let's call it book value. So I don't have to have a book value of 10,000. So my depreciation expense for that year is my original cost times my double declining rate, okay, 4,000. Now, my accumulative depreciation, by definition, right, it's all years depreciation up to this point. So because we have only 1 year, we have only one depreciation. So my book value put it in here. Pretty for you guys. So my first year is 40% of my book value. Now, my book value at the end of first year is my cost, right, minus my accumulative depreciation. In year 2, my depreciation expense is a book value times my rate. So my second year depreciation is only 2,400. So we take a book value and the beginning of a year times this rate. Now, what is my cumulative depreciation? Last year depreciation plus this year depreciation. This makes my book value, original cost, minus current accumulative depreciation. So I'm using it more. My brand new car getting used more. My new computer getting used more. So you guys guessed it. In year 3, I'm taking my current book value times my rate. And now my, let's see if my cumulative depreciation is prior year cumulative depreciation plus this year. And now my cumulative depreciation is 7,840. So now I'm going to take my cost minus my cumulative depreciation. Now it's 2,140. So we're getting closer here. So and something I have to mention, we cannot go below 1,000 because this is my salvage value. So here we don't care about depreciable cost when we do double declining method, but we will stop where our book value reaches 1,000. We're not going to go below that. So we have to keep watching that. I'm going to go to 2,100. 60 times my rate, it's 840. I take last year cumulative depreciation times plus this year depreciation. Not quite there yet. And now I take my book value minus my cumulative depreciation, 1296. So I can tell you right now, if I just take my book value times my 400, I cannot go below, right? 296. I'm going to go below $1,000. So I cannot go below 1,000. So I need this being 1,000 at the end of the day. I cannot go below my salvage value. That's something you have to watch out for. So I cannot depreciate 518. So now I have to do a little bit of math. I just have to go between those two numbers. So you're going to take the total of book value minus 1,000. You do want to do that calculation just to make sure you're not, under it. But if you're over it, you cannot go more than 296. And if you do that, your cumulative depreciation would be exactly 9,000, which is exactly where you want to be. So now we calculated double declining. It is work involved, and you do need to make sure you do your book value for this. So this is a lengthy one. Will take some practice, but it's very important to make sure that you can do this. So if you want to see this again, that's kind of in a PowerPoint format, the same concept, and this is your book value as we're moving along. All right. So make sure you stop and practice this, or maybe redo this one on your own to make sure you understand all the parts of this one. And this is kind of something brand new that you have not seen before, double declining balance. Something we don't cover, but we mention in this chapter, there's also tax macros, depreciation out there. We don't do this in this class. However, that is something to be aware of. There's more accounting depreciation methods out there besides what we're covering here. Okay, so now we don't buy everything on 1st of January and sell everything on December 31st. So what would we do if the asset is purchased in mid of the year? Well, we have a mechanism of allocating things per month. So for example, we're going to assume that we could purchase a machinery on October 1st, 2018, and we need to calculate depreciation expense for 2017, assuming we use straight line depreciation. So in this case, we have the same example, $9,000. However, remember that $1,800 depreciation, we're going to take 3 out of 12 months. So we're allocating based on months. Something to mention, this is your best calculator right here, your fingers. A lot of students say October, it's a 10th month, 12 minus 10. Why don't we just use 2 months? Because October, November, December is really 3 months because you have full 3 months. So I'm not embarrassed to say I use my fingers all the time. Don't just assume 10, 12, 2. 10 being October, 12 being end of a year. Kind of say, okay, it's the beginning of a month. We had machine for 3 months, therefore 3 12s. So we will be doing partial. So what if you have some information came your way? Maybe you know you cannot sell asset anymore for $1,000. Maybe you're planning to keep an asset. Instead of 5 years, you're planning to keep it another 2 years in addition to 5 year planning. So therefore, you're going to own asset for 7 years. Things change all the time. So if your new information being provided to you and you think it's going to change your depreciation, you can recalculate things. So you're not going to go back to previous years. You're just going to look at your book value. Here goes that word again. You're going to look at the current book value and you're going to calculate going forward new information. Okay? So how would that look in a real example? Let's say we have machinery from previous example and assume that in beginning of the asset, the 3rd year, so we have 2 years of depreciation, our book value is 6,400. So we have 10,000 cost left, 3,600 accumulated depreciation, and we use a straight line method on this one. At that time, it is determined the machinery will have a remaining useful life of 4 years. So remember, we thought we're going to have 5 and we used 2. So theoretically, we have 3 more, but we're thinking now we're going to have 4, right? So we added another year. And another thing happened, instead of having $1,000 salvage value, now we're going to have $400 salvage value. So what we're going to do, we're actually going to revise it as of it's a brand new machine. It's not, but we cannot go back. So we're going to take a book value, which is again, price you purchased at, less your cumulative depreciation, 6,400 minus residual value, the new one, divided by revised remaining useful life. So that's 4 years. So your new accumulative depreciation per year or depreciation expense going forward for this year would be 1,500. And now you have depreciation going forward for next 4 years. We're going to next topic, asset impairment. What happens if value of your asset declines or you think it's no longer can be used? So permanent decline in the fair value of an asset require writing off asset down to fair value. So what you'll do, actually, you're going to recognize impairment loss and just credit accumulative depreciation, and that's how we're going to journalize that. Now, I mentioned this earlier when I talked about acquisition. So if I have a brand new building and I have not moved in yet and I'm repainting it and I'm putting new cabinets in and new doors, all of that cost, we call it a capital cost, and can be rolled in the cost of the building. But once you start using the building, and if you need to repair the door or repaint it, we consider it to be an expense. It's wear and tear. So it is important to be able to distinguish between two, because capitalization requires you depreciating it and it becomes part of the balance sheet, where expenditure just goes to this year income statement. So revenue expenditures do not materially increase the planned asset life. They recorded as expense in the current period and reported on income statement. For the car, oil change, tires change, things that are kind of expected wear and tear. However, capital expenditures would provide benefits for longer than current period. Let's say I have a new transmission that increases life of my asset, or I am gonna build addition to the building, and now my building has a new wing to it that I'll be using for music classes. So suddenly that is a capital expenditure. And it's recorded as addition to an asset account and reported also on a balance sheet. So this is kind of summary. Ordinary repairs maintain normal operation condition that does not increase productivity and does not extend life. The capital ones would extend life and would increase production of the asset. Ordinary expenses would be booked and will go on that year income statement. Betterment of an asset will go on the balance sheet and will be included into depreciation expense for that year. What happens when we sell our asset? It's sitting in our book, so you have to write it down. Can you picture a company like Boeing who've been around for years and they keep every single asset they ever acquired sitting in there? You would be looking at their balance sheet. It'll be very long. So obviously, if they no longer have asset in possession, they have to write it off. They have to remove it. So when we bought an asset, let's say you debited machine and you credited cash, now you have to remove the asset physically through journal entry. Well, you physically have to remove asset as well from the books. So how do we do that? There's a couple steps to that. First, we're going to update depreciation on the date of disposal. So if I'm depreciating this in the middle of a year, I need to recognize depreciation expense after that point. Middle of a year, half of a year depreciation, 2 months of depreciation, whatever time it is. And then I have to journalize disposal. So we have a couple things here. We're going to record cash, receive debit or credit. Depends what's going on. Sometimes you might pay money for somebody to remove your asset. Removal, accumulated depreciation. So remember, normal balances have to be reversed. So normal balance of accumulative depreciation is credit, therefore we're going to have to debit it. the same thing with the asset, right? Your asset cost is a debit, therefore you're going to have to credit. So you're doing everything in reverse this way. It's not on your balance sheet. And then we're going to recognize gain or loss. Depends on the situation you have. So if the cash or exchange that you receive is bigger than your book value of your asset, you have a gain. If it's less than the book value of your asset, you have a loss. And if it's equal, there's no gain or no loss. So if I have assets sitting at 7,000 on my books and I got 8,000, I just got a gain. If I have a asset sitting at 7,000 and I got 5,000, I have a loss. So that's kind of where we're at. Let's look at example. A machine that cost us 9,000 with cumulative depreciation of 9,000. Looks like they completely depreciated on December 31st of the previous year, was discarded on June 5th of a current year. So discarding means we did not promptly receive anything, we just promptly send it to salvage recycling yard or something. The company is depreciating the equipment using straight line and over 8 years with zero salvage value. So in this case, there's no gain, no loss, no cash received. All we're going to do, we're going to debit a cumulative depreciation, credit machinery. It's completely removing it from our balance sheet. Let's use a different example. Let's say we have equipment costing 8,000 with a cumulative depreciation of 6,000 on 12/31 of previous year, was discarded on 7/1. The company is using straight line depreciation over 8 years. So first of all, we need to bring it to depreciation to the day of our sale. So we have a depreciation of 1,000 a year, right? We have 1,000 a year. And so they told us the 8. Oh, I'm going back. Okay. So the 8 years, no salvage value. So 8 divided by 8, it means 1,000 a year depreciation. I'm disposing this on 7/1. So again, we're not going to use 12 minus 7. We're going to use January, February, March, June, July. No. I missed the months there. January, February, March, April, May, June. So I have 6 months. I'm not going into July. So I have my 6 months, right? I have my 6 months. So 1,000 times 612, so only 500 depreciation expense. So 6,000 turned into 6,500 because of this entry. So now my cumulative depreciation decreased 6,500. My equipment that needs to be written off is 8,000. I'm not getting any money, but I have a loss, right? If it's a debit, it's a loss because now I discard something that has still a value that I did not depreciate it. Now, what if we have a equipment with original cost of 16,000 and has a cumulative depreciation of 12,000 at 12/31 of previous year? A BTO uses straight line depreciation at 4,000 per year. The equipment is sold for 3,000. So we're actually getting some money. So here we've been told what depreciation is. We don't have to calculate it. So again, we have 3 months. So do you see how this example gives you end of the month, where the other example give you beginning of a month? So this one actually does have just 3 months. January, February, March, 3 months. 3 out of 12. So you have another 1,000 of depreciation to recognize. That's your step 1. So now cumulative depreciation of 12,000 plus 1,000 is 13,000 that you have to decrease, less equipment of 16,000, and you're getting cash of 3,000. So you kind of fill in everything. And in this case, you debit equal your credits and you have no gain or loss to recognize. So that's amazing. That's good. You broke even on this one. We have to have a gain. We have to have a gain. We do have a gain. So we have the same situation, except now we're receiving $7,000 cash. So I'm not going to go over this. This is all the same story, just cash change. So again, cumulative depreciation, we're going to book 13,000. It's increased by 1,000 because of your caught up to the date of a sale. You have your equipment that you have to remove from your books of 16,000. You receive cash of 7,000. Now, I almost say gain or loss could be a plug figure. Your debits don't equal your credits. What do you need here? You need your $4,000. A credit is a gain, therefore 4,000 gain is booked in this entry. Again, you have a video, you can pause it, reread this, rewrite it without looking at this. Make sure you understand it, use it as a guidance as you doing your homework. This is good all-inclusive examples going through each different scenario. Let's look at one more. We have the same story, 16,000, 12,000 accumulative depreciation, and we have equipment was sold for 2,500. So in here, 13,000 accumulative depreciation, the same thing, equipment 16,000, cash 2,500. So now we have a loss. So on the debit side, we are short. So going back to the chart when we said about if cash is less, so we really, if you look at a book value, your book value is 3,000 and you're getting 2,500. So obviously you lost $500. So that's another way of looking at it. So if cash received is less than book value, it's a loss. If a cash received more than book value, it's a gain. All right, now we're ready to talk about natural resources. What is natural resources? Timber, oil, gas, things that are underground, things that somebody have to derive, that are natural in the world. So what we do a lot of times, and it's actually interesting, you would have somebody come in and actually try to estimate how much natural resources you have. Once that estimate has been made, you would use that figure. Again, it's an estimate, and if that figure changes, you would be actually revisiting your, and we call this depletion. Something I should probably mention. So when we have a fixed asset, we call it depreciation. When it's an intangible asset, we call amortization, and when it's a natural resources, we call it a depletion. So it's the same concept, it's just a different vocabulary what we use to reduce the asset cost. So total cost changes, and a lot of times assets used to derive the natural resource also would be tied to that. So mineral deposits with an estimate of 250 tons of available ore is purchased for $500,000, and we expect zero salvage value. So this method a little bit going to remind you of units of production because the concept is the same. So we're going to take cost minus salvage value. In this case, it's 500,000 minus 0 divided by 250,000. So each time we derive 1 ton of ore, and 1 ton is a lot, it's like 1,000 kilos, we can recognize a depletion, right? Depletion of $2. So in this case, we've been told it's 85 units expected and sold in this period, 85. So 2 times 85, we can reduce depletion by 170. So 500,000 is sitting on my balance sheet, and as I'm using my resources that year, I'll use 170 to decrease my revenue. So my depletion expense for mineral deposits is 170, accumulative depletion, which is a contra account to my natural resources, is right here. And this is how it would be presented on my balance sheet. So depletion expense when some are remain unsold at the year end, depletion expense 140, or inventory 30,000. So you might have some left. So if you did not sell it, it would be sitting in inventory, and then you'll have accumulative depreciation. So the other example had whatever we derived, we sold, but if not, we might keep it as a raw material inventory on a balance sheet. So specialized plant asset may be required to extract natural resources, and those assets are recorded in a separate account. So it could be a big, I wanted to use combine, but those big bulldozers and so on. So I'm sure there's a specialized name for those units. Intangible assets. So I mentioned them in the beginning, and we use word amortization for them. So this is things like copyrights and patents. So they are non-current assets. They're also going to be on a balance sheet. They'll have their own category. They often provide exclusive rights and privileges. A lot of times companies have to fight to keep those privileges, so it's quite expensive to maintain them. And they do have a value. That's why a lot of times get charged a lot of money. We recorded costs, including purchase price and legal fees and filing fees, when we apply for patent, or you can be buying things from somebody else. This is just some of the examples of costs of intangible assets. One of most familiar to you guys, probably franchising. You buy 9 rounds or some brand name gym membership that is available around the country. I mean, McDonald's is most common franchise probably in US. Those trademarks, that brand name is cost the money. They do marketing for you, but it also has things associated with that, and that cost can be allocated over a period of time. The last thing, and it will be calculated the same way we did the straight line depreciation, by the way. And the last thing, we are computing in this particular class ratio analysis as we go through each chapter that relates to that. And in this particular chapter, we can relate to computer total asset turnover and apply to analyze company use of an asset. So now we talked about the assets overall. So we can look at our net sales and divide it by average total assets. So what do we mean by average total assets? You take assets in the beginning of a year, assets in the end of a year, divided by 2. So if I give one individual a truck and another individual a truck and say, how much mulch can you deliver during the summer for me? How much sale can you generate? At the end of a day, I can figure out how much total asset turnover each of the trucks have generated. I mean, they both had the same territory concept, the same exposure. How hard did they work? How well they utilize the asset, right? So it provides information how company efficient on using the asset. So this is just an example. This is from a couple of years ago for Starbucks. Total turnover is 1.56. 1 year ago, 1.6, 1.65. So obviously, you want to utilize your assets more efficient than not to make sure that you're getting more out of them. So that's that. I'm gonna stop sharing and get back to my screen here. And that concludes our lecture on fixed assets. And please feel free to use it, rewind it, and make sure you can approach your homework. Thank you.